Good to have you with us, and thanks for tuning in to Mirror Now. Welcome to another episode of Investor's Guide, where we help you understand all about saving, investing, and how to make your money work for you. And of course, you can get all of your personal finance-related questions directly answered by the experts on our show. So whatever your question is, do send them in. You can email your questions to us on investorsguidemrn@gmail.com. You can call us on 022-6754-9546 or simply connect with us on Facebook or Twitter. Details of how to connect with us flashing on your screens. Let's straight get to our today's guest. Joining me in the studio is Feroze Azeez, Deputy CEO of AnandRathi Wealth Management. Feroze, thank you so much for joining us on another episode of Investor's Guide. Well, we've been flooded with questions and lots to talk about, so let's straight get to it. The first question coming in from Celestine Rodriguez, who says, I'm retired. Where should I invest to double my return? Can I invest in mutual funds, and for how long? I have got some fixed deposits in UCO Bank. Is it safe to keep FDs in UCO Bank, which is a loss-making bank? Also, I want to know what an index fund is. Okay, Feroze, so several parts to the question. We'll take them up one by one. The first part, I think the first thing would be, this doubling of income, expectation that people have really needs to be addressed, because something that you need to adjust is your expectations.
Correct. I think it's very important to have fair expectations from your investments. If you actually don't do that, then there is going to be disappointment. Disappointment will result in illogical actions and actually a detriment to yourself. So expecting about 12 to 13% return from your investments is not a very unfair thing, but anything more than that definitely is stretching it too much. So Avni, you're absolutely right. It's very important. Risk is nothing but defined as the difference between what you expect and what the reality turns out to be. So if your expectations are fair, it's quite likely that the reality will surprise you on the positive side rather than a shock on the negative.
Yes, absolutely. And what would then be your recommendations or advice for investing in mutual funds? And also she asks how long. So obviously that would depend on whether it's a long-term investment horizon or a short-term or a medium-term, depending on which funds you invest in.
So Celestine has also specified that she's planning retirement. So retirement could be broken into two parts. What happens is, if you look at life expectancy, looking at the actuary data of India, most people, the life expectancy is between 82 to 83 years, and that's high probability. So you have 20 years of retired life. So break it into two parts, first 10 years and the subsequent 10 years. The first 10 years money which you're going to consume have to be in safer assets. Return is not the driver of that strategy. The second portion of the 10 years money which you set aside for yourself has to be aspiring to grow further. So break your retiral corpus into two portions and have a different strategy for each of them is point one I'm making. Point two, how long can you invest in a mutual fund for? You can in fact invest in a mutual fund perpetually, but I think a 4 or 5 year time frame is a fair time frame for a mutual fund. But remember that you have to do reviews more frequently than the time frame which I mentioned. It's not that you go on a snooze mode for 4 to 5 years. Every 1 year review to see whether you're in contemporary schemes by writing into shows and finding out whether they still remain contemporary is important.
Yes, absolutely. And the other part of her question is, wants to understand what is an index fund. So Feroze, if you could just help us understand what is an index fund and who should really be looking to buy into an index fund.
Yeah, I think it's very important for all viewers to get to know what an index fund is. Index fund is nothing but a fund where the fund manager or the mutual fund money collected is not managed by an individual. It tries and replicates an index. And now comes the question of what is an index? Index is nothing but a group of companies which are brought together depending on their size, and a fund which tries to mirror it is called an index fund. For example, Nifty is an index which has 50 companies as per the top 50 companies of the country as per market capitalization. That means as per size. So index is what is Nifty. Any fund which tries to mirror that index, as the nomenclature suggests, is called an index fund, where the costs are lower because the human intervention of a fund manager to manage it is as much as zero. So I think that's an index fund. Replicating an index is what it is.
Right. And finally, the other last part of her question is whether it's safe to keep fixed deposits in UCO Bank, which is a loss-making bank. I think, you know, we need to address the larger question here, because ever since the Punjab and Maharashtra Cooperative Bank scam broke out and the depositors are going through so much, so much of a problem, Feroze, there is this perception across the board, and a lot of questions also we're getting is whether or not, especially from the smaller banks which are perhaps loss-making, whether or not their money is safe in those banks. How do you, what would be the advice for people at this stage?
Yes, Amni, I think it's a very, very pertinent question, or part of the question, that if I put my money in a bank, there is a presumption that I wanted to keep it safe, because bank is synonymous to trust and safety. If that gets challenged, it becomes a very, very difficult thing to come to terms with. So UCO Bank as a bank, of course, there are several banks, but profit is not what is going to decide whether the bank will be capable of repaying your money back, which you have kept in deposits. More so, their practices of lending. When the bank takes your money, it takes that money and lends it to somebody else. If they have lent it in a good fashion, then the money would come back, and in turn, your money would come back. So I think profits and losses will not change the probability of your money coming back, but it's more of the lending practice. But it's always important to remember that 1 lakh rupees per deposit is insured by the deposit insurance scheme. So if you have more money than 1 lakh rupees, it's always good hygiene practice to spread it across your family members. If you have 5 family members, 4 of them, spread it across 4. Each of them will be insured. So trying and spreading your money across different banks, across different people in the family is a good item, which is just a logistical nightmare, but it's worth, because it can give you sleepful nights after having spread it across names and branches, and bring down your risk considerably, or almost to nil. So that's what I think you should be doing if that's keeping you up at night.
Yes, absolutely. Moving on to our next question, comes in from Saili, who says, I'm a first-time investor. How should I start, and which funds can I invest in? I think we can club the next question as well, because it comes similar question coming in from Raju Boda, who says, I'm a first-time investor. Please suggest which funds to invest. So, Feroze, of course, a lot of first-time investors are writing in, and it's really heartening to see that irrespective of age, people want to start investing, people are curious to learn, people want to know the process. So, your advice to first-time investors, how do you go about this entire process?
See, first-time investors have to first make some key principles before they embark on the journey of investing. One thing which they have to keep in mind is they have to have goals. Right? Not having goals is like sailing without a compass. So always try and attach your investment to some objective which you have kept for yourself. Like if you have a child, save for his child's education, marriage, your own retirement, your car, your home. Make sure that you write down the 5-7 goals. That will give you a direction, and that direction will help you remain motivated and disciplined to invest on a recurring basis. So point 1 I'm making is have a goal. Point 2 is make sure that you don't do investing into stocks by yourself. Quite a few people get lured by friends' tips, and when another person says he or she has made so much money, they jump into the bandwagon and buy stocks themselves. If you're not doing that for a living, it's always good to outsource it to a mutual fund. Third, whenever you're a starter, invest in only liquid funds, liquid in the sense the ones which you can redeem. Don't lock in your money. These are the few principles. Having said which, for a beginner, you should start with a large cap fund. A large cap fund is one in which the fund manager invests only in bigger companies. So large cap funds is a good start point. The risks are limited. Those are not invested in small companies. So start with a large cap fund. Let me be more specific and tell you a Mirai Asset large cap fund could be a good start point. If you consistently invested it in the form of an SIP, I think it should do justice to your money.
Right. So those are 2 recommendations, Mirai large cap as well as Kotak multi-cap fund for first-time investors. If you want to just start putting in money through SIP every month, little bit, whatever you can. It could be as less as 1,000, 2,000, whatever you can put aside. Just start putting it into these funds and ensure that you hold it for a longer period of time. All right. We've got Mohan from Gurugram on the phone line with us. Hi, Mohan. Thanks for calling us on Investors Guide. Go ahead. What's your question?
Yeah. So I'm basically a teacher. and my salary is somewhere around 40,000 per month.
Okay.
And I have invested in ICICI Wealth Builder Plan too.
Okay.
Because somebody had suggested me to do so, so I just did it. And they have 1 lakh that I have to pay at the end of every year for 5 years.
Okay.
And then they say it will eventually grow and the things like that.
Right.
So, but
right.
whenever I open up the account link and things like that, I just see that like right now it's my 3rd year, so the 4th year, sorry, and there should be somewhere at least 3 lakh plus going in the account, and it's just less than 3 lakh. It's just going somewhere around 2,65,000 and things like that. So
Okay.
I just want to know that should I just remove the money after 5 years or should I wait for 10 years? Like I don't know.
Okay. All right. Mohan, I'm going to take your question across to Feroze. Feroze, so ICICI Wealth Builder Plan, from what I understood, I think this is his 4th year into the plan. What would be your advice on this one?
See, I think, Mohan, it's important to always remember this piece of advice of not trying to club insurance policies and investments. This is a ULIP plan, if I heard you right. It's a unit-linked insurance plan. So these plans are both insurance and investment combined. So the output you see after consistently being committed to the plan for 4 years, you are lesser than your capital value. That's because you've tried to combine these two objectives. If you would have bought a mutual fund from ICICI and bought a term plan from ICICI again, the output would be substantively better. So it's always good to segregate it. It is a criminal decision to actually invest in ULIPs. That's what data says. We analyzed 2,000 ULIPs and the returns after 10 years were abysmal number, less than 5%. I think so you should not choose ULIPs or traditional plans. The only insurance plan you should ideally buy, and that's what data says, not just me, is a term plan. And combine it with a mutual fund, no problem, because you've already put 4 years. I'm sure the plan allows you to invest beyond 5 years as well. Don't do that. At the end of 5th year, stop it. Stay invested in it, because a large portion of this charge you would have already paid. Now enjoy the platform for some more time. And I think further inflows should be into SIPs and buy a term plan for yourself to protect your life and any dependents thereafter.
Right. So after the lock-in period, perhaps he can move the money out of this ULIP?
Yes, ideally, but what happens is to give that specific advice, we'll have to see the cost structure of the exit.
Right.
That's why I'm being a little safer.
Okay.
Avni, you're right. He should consider an exit of the accumulated corpus, but you have to keep into cognizance the cost. Because tax is anyways not there. Cost is something which you'll have to be very careful about.
Right.
A large portion of your market value can be eroded as costs.
So Mohan, perhaps you can consult a financial planner, sit with them and figure out what the cost really is of exiting this ULIP once the lock-in period is over, and whether it's worth exiting it or holding on. But going forward, make sure you put in any money you want to invest. Ensure you put it into a mutual fund, and as far as insurance is concerned, opt for a term plan for protection. Thank you for calling us. All right, let's go across. We've got another caller, Nandagopalan from Madurai, calling us. Thank you so much for calling us. Go ahead. What's your question?
Yeah, I have some money with me, and I would like to invest in the monthly income scheme.
Okay.
Maybe it may be a dividend or an interest or something like that. But I don't prefer banks.
Okay.
So what is the possibilities or whatever is there?
Right. And what is your investment horizon? How many years are you looking to put money in?
It's not possible that I can bear how many, I mean, whatever you say, I can go through that.
Okay.
Maybe 5 years, 8 years, 10 years.
All right. All right. Well, Feroze, a monthly income scheme is something that he's looking at. What would be your advice?
See, if you want a recurring income, unlike banks, as a replacement to a bank's fixed deposit, for example, then you will have to use only debt schemes. Debt schemes are those schemes which invest in bonds and not in the stock market. For the benefit of all viewers, debt schemes actually bring in a lot of stability to the portfolio. So you have to buy a debt scheme, you have to take a dividend payout, so that these debt schemes generally have a monthly dividend payout. Several of them, especially in the short-term debt category, will have a monthly dividend payout. and then of course there's a dividend distribution tax which gets deducted. So it's important, if you are in the least tax bracket, then use a systematic withdrawal plan for the regular income. So point one I'm making is use debt schemes. Point two I'm making is do a dividend plan or a systematic withdrawal plan. A systematic withdrawal plan if you're in the highest tax bracket, a dividend plan if you're in the lowest tax bracket, and you don't care about the taxation bit, then you should go into a dividend plan. That will give you a recurring income on a monthly basis into your bank account, and the expected return cannot be too different than what a bank can give you. About 7 to 8% return is what you can on a recurring basis paid out to your bank account. Could be a fair expectation. Like Avni said, it's very important to have expectations on dot so that you don't disappoint yourself in the journey of investing. And lastly, make sure that you take a financial advisor's help, again, if those are retirement corpuses. But let me give you a couple of schemes which you can definitely look at. A Franklin Templeton Income Opportunity Scheme and a ICICI Credit Risk Fund. These two funds could definitely get you about 8.5% return over the next 3 years.
All right, Nandagopalan, well, hope that answers the question, and you've made note of the funds that Feroze was talking about. All right, shifting focus to our next question coming in from Avad Garg, who says, please share the meaning of financial fundamentals that I should know before investing in mutual funds. Well, Feroze, this falls straight, in line with the other two questions that we answered for first-time investors. This is perhaps the very basics that everybody who's looking to start investing should know. So let's, just go step by step. Let's just first talk about the different asset classes and what should be sort of, if there's any thumb rule, or how should one determine how much to invest into each asset class?
Yes, absolutely, Avni. I think the basics for all viewers are very, very critical so that they can commence this journey and not sit on the sidelines waiting and losing out the opportunity of the India growth story, which has helped several and should help the new investors. So when it comes to assets, there are quite a few assets, but to my mind there are only four which deserve some kind of mind share of investors: equity, debt, gold, and real estate. These are the four assets which you can live a life with, investing life with. Two of them are called growth assets. Equity and real estate have the potential to grow your money. Gold and debt have the protection attribute, and it protects your money. So growth assets and protection assets, two each, is important. Then coming to Avni, your question of how much in each of these assets, to my mind depends on two factors. One is your circumstance, and the second is the external circumstance. In the current contemporary situation, for a person who has a 10-year investment time frame, in my opinion, 60% can go into equity, 30% can go into debt, 10% can go into gold. Real estate should only be bought from a consumption standpoint and not from an investment standpoint. So 60, 30 and 10, provided you have a 10-year investing time frame from here to 10 years ahead.
Right. Now let's also talk about the different terms that constantly keep coming up. And if one is not familiar with them, it can appear like jargon. And in fact, these are terms that sort of very often tend to scare people because nobody understands what they mean. But actually, if we go to look at it, they're extremely simple terms. If once you understand what they mean, the first term to talk about is risk. What does it mean when, especially financial planners and on shows like these, we keep asking people when they write into us, tell us your risk profile. It means how much of a risk are you willing to take, when you put in money, because every investment comes with certain risks. Whether if you talk about equity, it comes with more of a risk of losing money, and debt comes with comparatively less risk. So Feroze, if you could just shed some light on risk and the importance of knowing one's own risk appetite.
I think risk is quite a misunderstood nomenclature, even to seasoned investors. But from a beginner's perspective, risk is one side of the coin. Return is the other side of the coin. Risk is nothing but your capacity to tolerate deviations from expectation. If you're expecting 10% return and if you got minus 10%, what's your tolerance to be stable during situations of such deviation is called your risk appetite. And these are measurable, and they are actually measurable. Now, for example, let me actually go into it. every fund tells you what is the swing possible. So standard deviation is a risk measure which mutual funds use. So standard deviation tells you the deviation possible in the expected return. For a beginner, it's important to begin the journey of understanding their own risk and trying and visualizing whether a 20% loss on capital is something which you can look at and still be emotionally stable with it. So that's one question you have to ask yourself. Risk is nothing but the deviation from expected outcomes as defined technically.
Right. And of course, you spoke about returns as well. Essentially, returns is what you end up actually getting. And like you said, risk and returns are two sides of the same coin.
Absolutely. Return is nothing but what I make. Now, seems very simple, but there are different ways to measure it. Returns could be measured as a lump or could be measured as a per annum return. Like when a bank fixed deposit tells you, I'm going to give you 10%, for example. So every year, on every 100 rupees you invested, you're going to get 10 rupees each, right? In 5 years, what did you earn? You earned 50 rupees. So 50 rupees is the cumulative return. Per annum return is 10 rupees on your 100 rupees. So a return is what you make. It can be expressed as a total quantum for the period of investment or could be measured on a yearly basis. And the better measure is the yearly measure, which is called the compounded rate of growth.
Yes, absolutely. And in fact, the next important term to know is what is a benchmark and why it's important, because every fund has its own benchmark. It's simply something to compare a fund's performance with. Is that right, Feroze?
Correct. I think benchmark, as the nomenclature suggests, is nothing but like a threshold which the mutual fund manager tries to beat. It's a threshold which the fund manager is overtaking. Like when a child writes an exam, there's a passing mark that, if I have to draw up an analogy, becomes the passing mark for the fund manager to justify charging you and me as investors to add value and create more return than the specific benchmark which he has set himself to achieve and beat. So benchmarks are passing marks of a fund manager so that he can overtake that and give you more value or more return and justify the fee he or she charges investors.
All right. And the other term, of course, is AMC, which is asset management company, and that's the mutual fund company or any company really which manages your assets or the money that you give to it, Feroze.
Correct. So mutual funds, in India you have about 40 to 43 mutual fund companies. These companies, as the name says, asset management company. Because we all do some other professions for a living, the money managed has to be outsourced to asset management companies so that they can do a far more professional job and a full-time job of managing the assets which you have entrusted to them. So there are about 40 to 43 mutual fund companies in India. Always remember that if you're a beginner, stick to the top 5 asset management companies. You don't have to go to the tail of it. And when you become a pro in investing, maybe you can venture into something which is the 20th asset management company. So on that, I'm just giving you a tip that stick to the top 5 if you're a beginner.
Right. And finally, NAV, or the net asset value. Again, this is a term that, scares a lot of people because nobody really understands what the NAV is. But Feroze, is it fair to say the way a stock price, you have stocks and you have the stock price, the price at which you buy or sell a stock. NAV is the price at which you would buy or sell a mutual fund in simple terms.
Absolutely, Avni. It couldn't have been put across more simply, and I completely subscribe to that. And only one thing is, when you have a mutual fund, you have several stocks. All the stocks are valued, and the total basket, which is nothing but a basket of shares. A mutual fund is a bouquet of shares. Valuing them and giving you a consolidated value as one number is called the net asset value. Like Avni rightly pointed out, it is nothing but the price at which you buy or sell the mutual fund, and it gets declared every day at the end of the day. That's the kind of transparency and regulation mutual funds bring to table, that every day an NAV would be declared to let you know what the value of your investment is.
All right, Feroze, I'm afraid we're completely out of time. And I think we've spent a lot of time on the basics of investing, basics of how to manage your money, which I think is very important because a lot of people have been writing into us who are first-time investors. So hope this episode really helped you, our viewers understand what it means to start investing and how to go about beginning your investment journey. Do write into us if you have any more questions or you want any more terms de-jargonized, or you simply want us to go through all of these terms once again. We'll do that as well. But we'll be back next week with a brand new episode. Until then, happy investing.